Hi there. Welcome to this blog where I'm going to be talking about accruals, an area that a lot of students find quite tricky to get their heads round. My name's Gareth. There's my contact details. You're more than welcome to get in touch. So my email address is garethjohn@fi.co.uk. I'm a managing director with First Intuition. I'm also quite active on social media. You can follow me on Twitter at AAT Top Tutor. First Intuition is one of the UK's premier accountancy training colleges. We train a lot of AAT students. We also train CIMA and ACCA students. We've been very, very, very proud in recent years to be nominated UK Accountancy College of the Year in 2010, 2012 and again in 2014. The only college, I believe, who's ever achieved that 3 times in 5 years. I was extremely proud to be awarded UK Accountancy Lecturer of the Year in 2011, and we were nominated for Study Resource of the Year in 2013 for some of the material that we produce for our students. So we're going to be looking at the accruals concept, and particularly how we actually create accruals for our accounts. Now, the accruals concept, sometimes also called the matching concept, because it's about trying to make sure that we match transactions to the correct period, that we match transactions to the period that they actually relate to. The thing you've got to bear in mind here is it doesn't necessarily matter when cash is actually paid or received, because cash can actually be paid or received sometimes before transactions occur and sometimes after transactions occur. And this is when we need to apply the accruals concept or the matching concept to make sure we match those transactions to the period they occurred in, not necessarily when the cash happened. Now, something that I'm quite a fan of when I'm dealing with the accruals concept is I like timelines. I use timelines just like a pictorial representation of a period of time, so I can try and make sure I'm putting transactions into the correct period. So for instance, let's imagine, and we're going to be looking at a 2-year period here, so let me imagine the first timeline is the first year. So that's year 1, from the 1st of January of that year through to the 31st of December of that year. And obviously at the end of 1 year you get the beginning of the next year, so we then get year 2, which will run from 1st of January of that year through to the 31st of December of the second year. And what we've just got to make sure is that we're matching transactions to year 1 if they relate to year 1 and year 2 if they relate to year 2, not necessarily when the cash occurs. Now, the kind of transactions when the accruals concept is often most appropriate is for utilities. Utility bills like electricity, telephone, water charges even, because the way a lot of utilities work is often you receive the bill after the period that it relates to. So for instance, if you've got a utility bill, and utilities often cover 3-month periods. So let's say we're looking at the first 3 months of year 1, so that would be January, February and March. We might receive a telephone bill, for instance. We may not receive it until actually after the end of that 3-month period. We might not receive that bill, say, until sometime in April. That's very common. It's what we sometimes refer to as invoicing in arrears. So we might not receive the bill for January, February and March until sometime in April. Now, just for simplicity, let's imagine that in year 1 our telephone charges are £100 per month. Let's say we have nice consistent usage of the telephone, £100 per month, which means that each bill we receive is going to be for 3 times £100. So in April we might receive a bill for £300. We'll then be using the telephone in the next quarter, in the next 3-month period. So that'll be April, May, June. But again, we probably don't receive the bill until after the end of that quarter, so maybe sometime in July. And again, if it's still £100 per month, let's say that we receive this bill for £300. Now remember, that covers April through to June, but we're not actually receiving it till July. Then for the next quarter, so that's going to be July, August and September. But again, we maybe don't actually receive the bill until probably sometime in October. So another 3 months worth of telephone charges, £300. Now the problem we then get is that the final quarter, because obviously a year is 12 months long, the final quarter we probably don't actually receive the bill until sometime in year 2. We probably perhaps don't get the bill for that final quarter until we're into January of the next year. Now remember, even though we're receiving the bill in January, and that's when we'll therefore be paying it, it actually still relates to year 1. And remember, year 1 is £100 per month, so that's still going to be a £300 bill that we've received from our telephone company. Now you can see at that point, we have got 4 bills that we've received, 4 bills each for 3 months, that's your 12-month period. The problem we've got is that only 3 of them were received during the accounting period. And what you have to bear in mind is that most of what we're posting into our accounts is based on what we call source documents, isn't it? So source documents such as invoices. And here we're receiving invoices from the telephone company during the year. So when we're actually drawing up our accounts, and you can imagine we'll be drawing up the accounts at the year end, at the end of year 1. And at that point, we've only received 3 bills. Now let's think about what that means about our nominal ledger at that point. So remember, your nominal ledger is where all of your various ledger accounts or T accounts are gathered. So I'd have a couple of T accounts that I'm going to be dealing with here. The most obvious one that I'm going to start thinking about is the telephone expense ledger account, recording the actual expense we've incurred for using the telephone. You can imagine your accounts need to represent the various costs you've incurred, so telephone, salaries, purchases, rent, all the various costs that go as part of running a business. Now, if we're posting into the telephone expense account on the basis of the bills we've received, the actual source documents we've received, now the double entry for a telephone bill would be debit the telephone expense, that's showing an expense that the business has incurred. The credit would be to cash, because when you get the bill you have to pay it, so you'll write a cheque for each of those £300, that's going to be a credit coming out of your cash account. Now, for the purposes of this, I'm not actually too worried about the cash account, but you can imagine there would be a cash account in my nominal ledger, but I've got, and let's number them off, 3 bills being paid, so debit the telephone expense to show the cost that we've incurred, £300 for the first bill. Now the other side would be going to the cash account. We've then got the second bill, which again is the same amount, same 3-month period, same £100 per month. So we're going to debit the telephone expense by a further £300, and then we've got that third bill that we received in October, and again we'd have a debit to the telephone expense with a credit going to the cash account. Now, bearing in mind that we're only posting into our nominal ledger based on source documents, the actual invoices we've received, you can imagine that at the end of the year, that's actually all we've posted, because remember, the 4th quarter's bill, that doesn't get received until January of year 2. So when we're drawing up our accounts at the end of December of year 1, we haven't got it yet, have we? We haven't got that source document, so there's nothing that would have been posted into our accounts. Now, if you look at how the telephone expense is currently standing, well, at the moment, we've got 3 lots of £300. There's £900 of expense in there. That's only 9 months, isn't it? And we know a year is 12 months long. So that is not an appropriate application of our accruals or our matching concept. A 12-month period needs 12 months of expense, doesn't it? Not just 9. Now, do you think we were using the telephone in the final 3 months of the year? Do you think we were using the telephone in October, November and December? Well, yes, we will have been. The fact that we haven't received the invoice by the year end doesn't mean I can ignore that expense. And this is where we need to build in an accrual. I just think of an accrual in simple terms as being an expense you've incurred. So we've actually used the telephone, haven't we? So it's an expense we've incurred. We just haven't received the bill yet. It's like an uninvoiced creditor, because I've incurred the expense and I do owe the telephone company. Imagine by the end of December, I do owe them for 3 months of telephone usage. The fact they haven't sent me a bill yet doesn't mean I don't owe them any money. I've used the telephone. Well, how do we set up an accrual? Now, well, think about what we need to achieve here. You can see the telephone expense hasn't got enough expense on the debit side. There's only 9 months worth of expense there. We need 12 months. So we're going to need to add an extra debit to the telephone expense. So we're going to debit the telephone expense to bring in this case, the extra 3 months that we require. Where's the credit going to go? Well, we can't credit cash in the same way that we have done for the 3 invoices we've paid. We can't credit cash because we haven't actually paid this final quarter yet, have we? We haven't even received the invoice yet. What we're going to do instead is we're going to set up a liability. We're going to set up a liability to recognise the fact that I do owe the telephone company for that last 3 months of the year. And this is what an accrual is. An accrual is just a liability, goes on the balance sheet, goes on the statement of financial position. It's just a liability for an uninvoiced creditor. It's an uninvoiced amount that we haven't received the bill for yet. So I'm actually going to set up another ledger account for an accrual. So it would just be another ledger account in my nominal ledger that will ultimately go on the balance sheet. In fact, I always like to remind myself of where each ledger account is going to end up. So telephone expense will ultimately hit the P&L or your income statement. That's an expense that will reduce your profit. The accrual, though, is on the balance sheet or the statement of financial position. That's a liability. This is what I owe to the telephone company. So let's have a think about what we owe them. Well, we are going to receive this £300 bill for the final 3 months in January. So that's how much I actually owe them. I owe them it at the end of December because I've already used the phone at that point. So what we're going to do, I'll put this in as transaction 4. We're going to debit the telephone expense by a further £300. Only difference now is the other side of that, remember, doesn't go to cash because we haven't paid it yet. It's going to go to the accrual. And a credit is how we set up a liability, isn't it? It's part of the click of our dead click principles. So I'll just abbreviate there, telephone expense. So I credit the accrual, which is showing the liability that I owe to the telephone company. Now that's at the end of year 1. Now remember, the whole purpose of this is to try and apply our accruals or our matching concept. If I was to now balance off my ledger account, so at the end of year 1, we'll go through our usual process of balancing off each ledger account to get figures for the trial balance. Well, when we're balancing off the telephone expense account, just in the usual way, you look at both sides of the T account. In this case, you can see we've only got figures on the debit side. 4 lots of 300, which comes to a total of 1,200. So put the higher of the two sides in both total boxes and then set up your balancing figure. I think of it like a set of scales. We need to make sure the scales balance. So my balancing figure here is the 1,200. And because that's a P&L ledger account, that will actually get cleared to the profit and loss or the income statement for that period. So at the end of year 1, we're going to recognise £1,200 of telephone expense. And would you agree that's correct? Because we had 12 months, each at £100 per month. So you can see by introducing the accrual as a further debit on the telephone expense account, we've correctly identified the full expense for year 1. Well, we would also balance off the accrual ledger account. Now in that case you've only got a figure on the credit side, so I put the 300 on both sides, and again to make the scales balance I need a balancing figure, in this case on the debit side. And because the accrual is a balance sheet item, remember balance sheet ledger accounts don't get cleared off to 0, they get carried down to the next period. So we'd have a carried down balance of £300. And remember, that would get carried down onto the other side. So at the beginning of year 2, we've got a brought down balance of £300 because on the 1st of January of year 2, we still owe the telephone company that £300. We've used the phone for 3 months, we owe them the money. And so at the end of the period, as well as recognising £1,200 of expense in the P&L, we're showing a £300 liability, a £300 accrual, which would be sitting on the balance sheet. Remember, that's an uninvoiced creditor, the amount I owe the telephone company for the fact I've used the phone. They just haven't sent me an invoice by the end of the year. Now that's looking at year 1. Now you can see we've effectively done 2 things in year 1. Throughout the year we would have posted the cash we've paid, which remember was for the first 3 telephone bills that we'd had. So we would have posted the cash for those 3 telephone bills. At the end of the period then, at the end of the year, we then had to set up the accrual to recognise the additional 3 months' worth. And the accrual itself, that double entry we posted for the accrual, that would effectively just be a journal done at the end of the period. So on the 31st of December, typically, we'd sit down, we'd work out all of the accruals we need in the accounts, and we'd post that through just to make sure that the year-end figures are representative of the full year. Well, what if we now move forward into year 2? So year 2 is our year ended 31st of December 2016. This is now the second year on our timeline. Now, during year 2, well, in January, well, actually, we already kind of know about this because we've already been talking about what was happening at the end of year 1. And if you remember the last quarter's bill, so the last 3 months' bill for October, November, December, we didn't receive till January. So, in fact, we already know about that £300 bill coming through, 3 months at £100 per month. That's already on our timeline, if you remember. That's effectively that fourth bill that we received. Now, that's still at £100 per month, because that still relates to year 1. But imagine in year 2, we start using the telephone more. Imagine in year 2, we're expecting our bills to be £200 per month. Now, remember, that's not going to affect that first bill received in year 2, because that was actually for the end of year 1, wasn't it? But now, when we start looking at bills for the remainder of year 2, they're going to be a bit higher, because 3 months at £200 per month is now £600 per bill. So when we now receive in April, and this will be for the first 3 months of year 2, this is for January to March, we now get a bill of £600. In July, which is for April to June, we get another bill for £600. Then in October, which is for the period July to September, we get another bill for £600. Again, you can see the way that the invoices, the bills are being received in arrears. They're being received after the period they relate to. So that means that for the first 3 months of year 2, we don't get the bill until April. Remember, that's for £600. Next 3 months, we don't get a bill until July for £600. And then the next quarter, we don't get a bill until October for £600. Now that completes the bills that we've actually received during year 2. You can see we've received a total at that point. Well, we've received a total of 4 bills during year 2. Which kind of sounds okay, doesn't it? 4 bills, 3 months each, that's 12 months. Surely that sounds sensible, but you've got to bear in mind the first bill didn't relate to year 2, did it? That actually still related to year 1. It was just received a bit late, wasn't it? Now, we've actually already accrued for that £300 at the end of the first year. Remember, that was what brought in that extra £300 at the end of the first year. So, in effect, we've already dealt with that bill, haven't we? We've already applied our accruals concept by taking account of that during year 1. So, in effect, you can see we're only left with 3 bills that we've dealt with that actually relate to year 2. Because the final quarter, in the usual manner, isn't received until the following year. In fact, you can see that the bill for October, November, December, the final quarter of the second year, we're not receiving that until January of the third year. So we actually wouldn't be receiving that until January. That's £600. And even though that's received in the third year, that actually relates to the second year, doesn't it? So again, we've got to be very, very careful here. We've got to make sure we're applying our accruals concept. Can you imagine? It'd be very easy here to think, well, the telephone expense for year 2 would be 300 plus 600 plus 600 plus 600. Now that would actually give you a total of 2,100. Might sound reasonable. But bear in mind, year 2 is at £200 per month, isn't it? 200 times 12. It should be 2,400, shouldn't it? Now, compared to the first year, we've actually got an additional complication brought in, and it's this fact that the first bill that we received during year 2, the first bill that we would have paid, actually relates to the previous year. Now, this is because we've got this brought forward accrual that's actually come from year 1 into year 2. We were basically saying that at the beginning of year 2, we actually already owed the telephone company £300. Now, when we have brought forward accruals, the same would apply to brought forward prepayments, I always follow a 3-step process for dealing with the brought forward accrual and indeed then what's going on during the year itself. So this is what's going to now happen in year 2. Now the first thing we need to do is we need to reverse the brought forward or opening accrual position. Now when we say reverse it, It literally means posting the exact reverse or the exact opposite of the double entry that we posted to set it up. So to set up the accrual, which was at the end of the first year, if you remember, we debited the telephone expense, credited the accrual. At the beginning of the following year, and you'd literally do this on the 1st of January, you'd reverse out your accruals, you just post the opposite. So we'll now debit the accrual and credit the telephone expense. And we'll see exactly why that needs to happen when I start pulling my ledger accounts together. So we're going to start by reversing the opening accrual. We then go through the year and post the cash payments made in the year, so based on the source documents that are floating around. And then at the end of the year, we need to set up any closing accrual positions or prepayments if you were dealing with prepayments. So 3-step process. We reverse the opening accrual, we post cash payments for the period, and then we're going to set up any necessary closing accruals. Well, to do this, I'm going to set myself up again some ledger accounts. So these are ledger accounts for year 2. And again, I'm going to focus on the 2 same ledger accounts we've been dealing with. The telephone expense, which if you remember is a P&L ledger account, and we've got the accrual itself, which is a balance sheet or a statement of financial position ledger account. Now, because the telephone expense is a P&L ledger account, at the end of the first year, if you remember, would have cleared off the balancing figure. That would have been cleared to the P&L, recognised as a cost for the first year, and that would have cleared it off to nil. So expense T accounts always start the new year empty. There'll be nothing in it because it will have been cleared off at the end of the previous year. But with balance sheet ledger accounts, those figures get carried forward to become the brought down or the opening balance in the following year. So you can see if we set up the accrual for £300 at the end of the first year, we would therefore already have that £300, and it was a brought down credit balance. So at the beginning of the second year, we've actually already got a £300 credit balance on the accrual. Remember, that's just saying that at the start of the second year, we already owe the telephone company £300. We owe them for the last 3 months of the previous year. So we've got an opening or a brought down accrual balance. Now, the first thing we said we need to do is to reverse that opening accrual. Now, to reverse the opening accrual, we just post exactly the reverse or opposite double entry. So instead of debiting the expense, crediting the accrual, we're now going to debit the accrual. So if I number my steps off here, 1, 2, 3. So step 1 is we now debit the accrual and credit the telephone expense by the £300 that we set up at the end of the previous period. So just to show where the other side's going. So in the accrual ledger account, we'll just put a reference into the telephone expense. And in the telephone expense, just put in a reference to the accrual. So that's the reversal of the opening accrual. Now, I'm hoping what you can see is that's immediately cancelled off the accrual ledger account. That's kind of cleared it off to nil. Because can you imagine, as soon as you receive the bill and pay it, you're not going to owe it to the telephone company anymore. So you don't need the accrual anymore. And we'll see the impact that the credit on the expense account has in just a second. Because the second step is to now post the cash payments made during the year. Now, if I go back to my timeline, I do find timelines phenomenally useful in these kind of situations. Can you see we have got 4 cash payments during the year? One for £300, which was sort of done in January, and then you've got 3 for £600 each. So let's post those cash payments. These are the source documents. These are the invoices that we've actually received. So we'd have the first one, which was for £300. That was the January payment that we would have made. Now remember, the other side of these double entries are going to go to the cash account. I'm not particularly interested in keeping the cash account, but I'll put the narrative in. The second bill in year 2 was for £600. The third bill was for £600. And the fourth bill was also for £600. Now, can you imagine if we were just leaving the telephone expense like that, if all we had was those 4 debit entries on it and let's say there was no credit entry, that's where you would get your 4 quarterly bills, which sounds okay, 4 bills over 12 months. But if you add up 300, 600, 600 and 600, that's £2,100. That's not correct because we know year 2 is £200 per month. That should be 2,400. And the problem is that first payment, that first bill, was actually to do with year 1. If you remember, It's actually already been accounted for when we set the accrual up back in year one. That's already been accounted for as a cost of the business. So we don't want to account for it twice. And that is exactly what the reversal of the accrual has done. Can you see that the credit of 300 has literally cancelled off that first debit that we've entered for the first bill that we received during year two, because that didn't actually relate to year two. You see that the reversal of the accrual is actually applying our matching principle to say, well, that first payment, that's nothing to do with year two. We've already dealt with that in year one, so we cancel it out. Now, given that the debit on the 300 and the credit of the 300 kind of cancel out, that means I'm now left with just 3 lots of 600 sitting there. Now, 3 lots of 600 would be 1800. That's effectively just 9 months worth. Now, why is that only 9 months worth? Because the final bill for year two, if you remember, that's not received until year three. So that wouldn't be a source document at the end of year two. We wouldn't yet have dealt with that. We wouldn't have posted it into our accounts because we haven't actually received the bill yet. That's why we now need to set up a closing accrual at the end of the second year, because we've still got to recognise October, November, December of year two. We've been using the phone. We've got to show the cost. Now, we know the double entry for setting up an accrual. It's what we did at the end of year one. It's the same double entry, debit the expense, credit the accrual, just for a different figure this time, because we now know that the bill we're going to receive is for 600. Can you see, if you look at my telephone expense ledger account, can you see effectively what I've got is at the moment, I do have 12 months worth on the debit side, but we reversed 3 months out because that related to year one. So at the moment, my telephone expense only really shows 9 months worth of cost, which is why we're going to need to bring in an accrual. And again, we haven't actually paid the cash here, so I can't credit the cash account, but we will set up the credit to the accrual. And this is just exactly what we did at the end of year one. So we debit the expense to bring in the extra 3 months we require. We credit the accrual, because again, at the end of the second year, we again owe the telephone company some money. We just don't owe them 300 now, we owe them 600, don't we? In fact, can you see that's why we reversed or cleared out the opening accrual, because that 300 is not relevant anymore. We actually owe them 600 now. So can you see I've now gone through this 3-step process. I've reversed the opening accrual to effectively eliminate that first bill from year two, because it wasn't anything to do with year two. We've then posted the cash payments made during the period, which was the 300, the 600, the 600, the 600, and then we set up a closing accrual at the end of the year to recognise an additional 600. And if that's at the end of year two, if that's now the 31st of December, if we clear off our T accounts, balance them off, well, in the usual way, if you look at both sides, you can see on the telephone expense ledger account there's far more going on the debit side. If you add up those 5 figures on the debit side, 300, 600, 600, 600 and 600, that comes to a total of 2,700. And therefore my balancing figure to make my scales work, well, there's already 300 on the credit side from the reversal of the accrual. So can you see I now get a balancing figure of 2,400 to make the credit side balance. And again, that's the figure that would be posted to the P&L. That would be cleared off to the P&L. And so at the beginning of year 3, again, you'd have nothing sitting in the expense account. But can you see that that P&L expense of 2,400, that's correct now, isn't it? Because that is 12 months at £200 per month, which is what we knew year 2 was. And if I clear off now the accrual T account, well, you can see there's actually more on the credit side. There's 900 on the credit side. So my balancing figure, well, to make the debits equal 900, I need a 600 balancing figure. Now that is the carry down balance at the end of the second year, which would therefore be carried down. There's a brought down balance at the beginning of the third year, because again, on the 1st of January of the third year, well, actually, we still owe the telephone company some money. We owe them 600 quid for the use of the phone at the end of the second year. That's that bill that we're going to receive in January of the third year. But again, when we get into year 3, the first thing we would do is to reverse that opening accrual. We'd again reverse that opening accrual of 600 to make sure that we're applying our matching principle. So I'm hoping you can see through, in this case, year 1 and then year 2. Firstly, you can see that in year 1, we recognised the correct expense for telephone of £1,200. That was 12 months at £100 per month, but we were only able to do that by bringing in this accrual at the end of the period, this extra 3 months of cost that we needed to account for. And then similarly in year two, a bit more going on in year two because we had that opening accrual, but again we've got the correct expense for the year, 12 months at £200, and we only got that firstly by reversing out the opening accrual of 300 to effectively eliminate the impact of that first bill, but then we had to account for a closing accrual at the end of the period. In fact, what you'll often find is that if you have an opening accrual, you'll probably end up with a closing accrual as well. And similarly, this sort of logic applies to prepayments as well. If you have an opening prepayment, you'll probably end up with a closing prepayment as well. So, hoping that's made a little bit of sense. Accruals, prepayments, I mean, it is quite a fiddly topic. It's something students often have to spend a bit of time working on. So I'm hoping that has helped you a little bit. But thank you very much for paying attention. Thank you for your company, and I'll maybe see you at the next one. Goodbye.